You can do anything with the lights, Jim?
I think we're good.
Do we need the handheld mic?
Yeah, there you go. It's right there.
There's a lapel mic up there too somewhere.
Thank you for joining us. My name is Melanie. This is Aiden, Eric, and Zach, and we are from the University of Montana. Based on our analysis of Redline, we are recommending a buy for a one-year target price of $12.32, which is a 21.38% premium to the closing price as of January 12th of $10.15. We have also estimated a fair price of $10.23, which is a 0.79% premium to that closing price, as well as a bull price of $16, which is a 57.64% premium to that closing price as well. Our recommendation is based on three catalysts. The first one is the transition to an asset-light business model, which is following the movement of Marriott and Hilton as Redline looks to become a franchisor. And this model typically involves higher market multiples as well as lower leverage. We have also seen the possibility of acquisition in the industry. Most recently, La Quinta was acquired by Wyndham Hotels for 17 times for their EBITDA. And as Redline continues to grow, we see the possibility of them looking to acquire smaller hotel chains as well as be acquired for more than their market value. And lastly, we were considering political and economic changes. Most recently, the new tax bill initiated by Trump, which lowers corporate tax rates from 35 down to 21%, which would be very beneficial for Redline as most of their revenues are derived domestically, ultimately impacting their bottom line. And here we have a summary of Redline currently, including franchises. They have over 1,100 hotels with more than 73,000 rooms across 48 states. They employ about 1,800 people and own 12 brands.
Redline Hotels brand portfolio consists of 12 different brands, and they range from upscale down to lower economy segments, and so they've penetrated just about every market segment in the lodging industry. 58% of their revenue comes from American Best Value Inn, along with Canada Best Value Inn, which makes up over 800 hotels in their brand. And so Redline Hotels has a couple of different strategy and initiatives they're working through right now, and they sold off their Ticket West and their West Coast entertainment legs of their business, which was initiated by the new management coming in a couple of years ago. And then currently in 2018, they set a goal to sell the rest of their hotels that they had, and it was over 10 hotels, and they have about 6 left. And then they also have implementing operating tools, including Hello Rewards and RevPack. Hello Rewards incentivizes return customers, and RevPack is basically a marketing analytical tool for franchisees. Recent history, in 2008-2009, room rates fell by 6%, compounding to RevPAR decreasing by 18%. And then the asset-light transformation rebounded the lodging industry after the crisis. The consolidation in the industry has formed 6 of Redline's competitors to own about 50% of the market share, with Redline Hotel in the minority. Yeah, and with the asset-light transformation, their revenue is derived from management fees and royalty fees. In their industry overview, with some of their biggest competitors, they are substantially smaller relative to their market cap. And we see this as a competitive advantage because if you stay at a Hyatt, Hilton, or a Hampton, there are no differences between the rooms. And so Redline Hotel can offer their franchisees a little more freedom with originality and authenticity with their rooms.
I'm going to talk about the method that we use for evaluation. So we use a combination of 2 different methods. The discounted cash flow method, which is pretty common, and then an enterprise value EBITDA peer multiple comparison. The reason we chose these two multiples, the discounted cash flow is a pretty standard, like I mentioned, valuation tool, and then the enterprise value to EBITDA metric is appropriately used in the lodging industry, especially with comparisons and acquisition pricing multiples. So our discounted cash flow analysis, we projected income statement, balance sheet, and cash flow data forward 5 years, and then used a fixed growth rate for NOPAT and increase in capital, which was tied to inflation and our projected growth for the company. For our discounted cash flow, we used an 8% weighted average cost of capital, despite the debt rate being around 7% and the stock rate being historically just a touch lower. We decided that a conservative weighted average cost of capital was appropriate given the market conditions that we see on the horizon and some of the potential risks that we analyzed. Our intrinsic value that we reached for our discounted cash flow is $12.57. For our peer enterprise value and EBITDA multiple comparison, we looked at what Redline is traded at in the past. Currently, they traded about, and this was during our pricing analysis, they traded about 10 times their forward EBITDA. The industry average is around 15% for franchisors, and they traded far below that. However, we assigned a 13.5 times multiple because they're not a mature business in their new business model, and there's still risks associated with the transition. So this multiple valuation gave us an intrinsic value of $12.07, and the two combined weighted equally gave us an intrinsic value of $12.32 as a whole.
All right, so when we were assessing the risk faced by Redline, we broke it down into market risk, industry risk, then company-specific risk. There is potential for valuation bubble in this long bull market we've all been experiencing. The market typically corrects or pulls back every 10 years or so, as we kind of got a glimpse of in this past week. When that does happen, small caps typically become more volatile and are hurt more. And our figure in the top right shows kind of these two small cap Russell funds being hurt much more than the Dow post-financial crisis. We are currently in year 9 of a lodging cycle, lasts about 5 to 10 years. At this current peak, occupancy rates reach about 66%, just 260 basis points higher than the last peak back in 2006. And then we ran a Porter's 5 Forces analysis to assess some of the threats Redline faces. Two of the biggest threats being threat of substitute products and competitors in the industry. Basically, if you're a homeowner now, you are a competitor to Redline with the presence of Airbnb and VRBO, and online travel agencies just putting the power in the consumer's hands to choose, a lodging solution that fits their price and location needs. And specifically with Redline, they are undergoing this transition to pay down debt through the sale of assets. Then if they're unable to sell those assets in a timely manner, they could potentially run into some trouble as current free cash flow generation is not strong enough to meet their business goals. Then we were looking at corporate governance. We really like the board structure and executive management of Redline. The executive management team has about 150 years combined industry experience in critical areas such as implementing growth strategies and asset-light transformation we've been talking about. One area we did assess moderate threat to shareholders was under executive compensation. This was more tied to the bonus structure they have in place. Under that bonus structure, management is rewarded a cash bonus if they reach 87% of their EBITDA target. Anything less than reaching 100% typically draws a negative reaction from the markets, from analysts and investors. With the CEO's current ownership in the company, the stock price would have to drop more than 50% for his minimum cash bonus to be completely canceled out. So there is potential for that discrepancy with stock performance and the cash bonuses being awarded. We do like the performance-based compensation plan and the industry experience that all these managers have. And so we assessed insignificant threat to low threat to shareholders and corporate governance. And so in summary, we are recommending a buy of Redline stock at a current price of about $10.15 with our 1-year price target of $12.32.
Great. So, is that it?
Yeah.
Okay. All right. Ready for questions? What does the supply dynamics look in their markets? Where are they most focused, and what's the the new build outlook. Did you take a look at that and do any analysis? And I think you mentioned we're in the latter stage of the real estate or the hotel cycle. Yeah.
So in the supply situation, from that perspective, one thing that we did look at is the way that Red Lion, especially with their new RL hotels, wants to implement their franchise strategies. And Red Lion is individual in the standpoint that they only want to implement new franchises in already existing buildings, whereas lots of other major hotel chains want to build new supply. And I know Zach mentioned that supply, and especially the amount of hotels that are in current available buildings, is pretty high, being that we're at the peak of the lodging cycle. So Red Lion's use of already existing structures is competitive from our perspective.
Right, got it. And they are how far through the asset, disposition cycle, and then the franchise? They've done 6 of 10. Did you mention how much capital do they raise from that program?
So I don't have a capital specific number. However, I do know that they've already agreed on the sale of 5 of the 11 listed hotels per recent press release. The sale prices that were reached on those 5 hotels were at or above the expectations, and they affirmed their guidance of selling all within 18 months and potentially even sooner.
Pass the baton over to Craig. Go ahead.
Okay. Explain how you come up with a forward-looking growth rate and break it down between organic and inorganic growth.
Is that pertaining to the next 5 years or long-term, or do you want me to discuss both?
Both.
Okay, so short-term, it's a little bit easier to project in the next 5 years how we feel the company will grow, especially with their franchise transition. So part of our growth rate is attributed to, of course, economic growth that will drive revenue or economic contraction. We believe that the economy will face some sort of contraction in the next few years, nothing compared to 2008 when it was severe, but some sort of decline that will eventually stabilize in the next 5 to 6 years. We also factored in inflation. We projected a low inflation rate, somewhere around the 2% that's continued today. And so even though we used a 5% NOPAT growth rate over the long term, we think that factoring in that inflation and the economic growth, that's a conservative number, considering the fact that they're transitioning to a different business model and have excellent franchise growth.
So your growth expectation for 5%?
5% in years 6 through 10 for net operating profit after taxes. And they're a little bit higher than that in
And
the
what
short
was the
term.
growth rate for year 1 through 5?
It ranges. Right now it's about 15% and sort of decreases down to that 5% level that's reached in year 6.
And all of that growth is just from existing franchisees?
Yeah, so in our discounted...
No acquisition expected?
So there is an acquisition possibility, but in our discounted cash flow analysis, we didn't price in acquisition. We talked a little bit in our analysis and as a group about the possibility of an acquisition multiple being much higher, and that's kind of what we discussed when we came up with our bull case. Obviously, our bull price is a lot higher, and we attributed that partially to the possibility of them being acquired at closer to 17 times EBITDA, which could lend to an $18 or $19 per share stock price acquisition.
Okay, one last.
Right.
This was 15% for the first 5 years, and that's just through rate improvement and occupancy improvement?
No, sorry, 15%, somewhat but not exactly linearly, decreasing to that 5% in year 6.
I noticed in terms of at least the most recent quarter, and I didn't go back in a tremendously long period, but it seems that their own hotels division actually has higher operating margins than their franchise business. Why do you think they would be emphasizing their resources towards a lower operating margin business of the franchise versus the owned hotels?
I think it basically comes down to revenue stability. And so one of the ways to fight market volatility within the lodging industry is to have basically a fixed income, so that they're getting royalty fees and management fees, although the margins are a lot smaller. It's basically a hedge that they're using against volatility. And so that's why they're kind of going to they're lightening their balance sheet, and they want to basically just hedge against any sort of downturn in the market.
Okay, so if to me, it appears that most of their franchise agreements renew on a yearly basis. Would you be concerned in an economic decline or a slowdown that potentially that would squeeze the franchises and force them to look at other alternatives other than franchising with Redline?
We think that one of the competitive advantages to Redline is the relationship that they have with the franchisees, because they allow them so much freedom and a lot of opportunity to be able to do business with Redline Hotel. I think when the CFO was talking, he was saying how the executives that they wanted would go out to their hotels and things like that. You can find that kind of relationship with Marriott or anything like that. So I think there are a lot of benefits that aren't quantifiable with the kind of relationship that they have with their franchisees, and I don't think that Marriott and those kind of things can offer that.
So do they have any history of doing deferrals with their franchise partners? That the franchise partners getting squeezed on their side, that they'll do a deferral, it'll accrue, or how do they handle that in terms of working franchise partners?
So I'm not sure that that's a metric that we exactly analyzed, but to add on to what Hayden said that I think might assist in answering your question, one of the things that Redline has done recently was the Vantage acquisition. So if you look at Redline, a lot of times you just think of Redline Corporation as the Redline Hotels, but when you think about their brand portfolio, which we discussed is pretty vast, it's 12 different brands that span almost the entire lodging segment. Even if some of the upscale or mid-scale hotels suffered, the majority of their hotels that they franchise out are America's Best Value and Canada's Best Value, which theoretically should be somewhat counter-cyclical in an economic downturn. So I guess our analysis.
Because they're more affordable.
Sure, exactly.
How do the franchise agreements work? Is it a percent of top line, and what's the duration on those typically? Can you give me some understanding as to how they arrange that?
And so I don't have currently any specific numbers, but basically the dynamic of it is they have their management fees and their royalty fees. And so Redline gets their royalty fees every year, just like any franchise. And that's a fixed fee for their economy and lower economy. And I believe they're everything but their upscale essentially. And so those are fixed fees, and then they also have management fees that if the franchisee wanted to basically outsource to Redline with employees management, software, things like that, they pay them a fee with that. But if they also can hire their own employees and things like that, which that management fee would not be paid to Redline. But with their hotel RLs, they get a variable pricing, so they want to capitalize on that. I remember them speaking about because they think that would be one of the biggest money makers, even though they own about 10 of those in the nation right now.
Okay, so the fees, royalty fees, those are static. Those aren't necessarily, percent of revenue.
No, the only percent of revenue are the upscale hotels they have.
Okay, and any trends in RevPAR, per brand that you did any analysis on? Revenue per average room?
We did.
So yeah, we did a RevPAR analysis for the individual brands of Redline, but we didn't look across the industry at different RevPAR estimates. Since the financial crisis, obviously RevPAR has increased dramatically, and we think that that's partially attributed to the change in structure that many companies have chosen to implement that Redline is going to be choosing as well.
Got it. Okay.
Do you know what the franchise revenues are per franchisee? The blended average for the entire company?
No, I'm sorry, I don't think we have that figure.
Did you guys look at NOLs at all? I believe they have NOLs and how that would potentially impact their GAAP versus pro forma earnings.
Sure. So we did look at NOLs, and there was a slide earlier on that I think is easy enough to explain, but not refer back to. It was showing earnings per share affected by the new tax bill.
Time. Thank you, guys.
Good job.
Thank you,
Thank
guys.
you very much.